Okay, so continuing with Chapter 9, now we want to talk about the allowance method. So the allowance method is required by GAAP so that we have an accurate estimate. And so in this case, we have to estimate. We don't wait until people actually write off. We have to estimate what that bad debt, that bad debt expense is going to be. So we're going to, did that twice. Debt expense will be. So we're going to kind of set some money aside that we're going to write off. So at the end of the year, we estimate what our bad debt expense will be. And so let's say it's 12/31. So this would be my adjusting entry at the end. I'm going to debit bad debt expense. And this is what I estimate my expense is going to be for the coming year, but I don't know yet who those people are going to be. So I credit allowance for bad debt. So because I can't credit a specific accounts receivable because I haven't written off yet. So I'm doing the bad debt expense before the actual write-off happens. And so I don't know yet which accounts I'm going to write off. I can probably estimate pretty accurately how much I'm going to have to write off. I just don't know which specific accounts receivable they are. So I set it aside in this allowance account. And then during the course of the year, when I identify specific accounts to write off, it's going to come off of their accounts receivable, but I'm not going to debit bad debt expense because I kind of already did that before it happened. So I'm going to pull from this allowance account, so this money I have set aside for that. So when I identify specific accounts, I will debit allowance, for bad debt. We used to always call it doubtful accounts. So allowance for bad debt. And then I will credit accounts receivable, whoever it is. So this first one here is the adjusting entry, and then this is when I identify specific accounts. So here's a problem with that one. They give us a couple account balances here for accounts receivable and the allowance account. And then we have a couple different things happening. We make some more sales on account. So we collect some accounts receivable. We write off somebody. And then we estimate the bad debt for the coming year. So this is actual write-offs, and this is the estimate essentially for next year. So first they want us to journalize these 4 transactions. So the first one here, I make sales on account, and it says ignore the cost of goods sold. So this would just be a debit to accounts receivable and a credit to sales revenue for $265,800. And then I collect money, and so whenever I collect on my accounts receivable, I debit cash and I credit accounts receivable for $220. And then I wrote off specific accounts. So when I write off accounts, remember that's I'm pulling from that money I set aside. So I debit allowance for bad debt, and I credit the specific accounts receivable accounts. So that's for $6,100. And the last one is a bad debt expense. Again, this is kind of my estimate for next year. And so for this one, I'm going to debit bad debt expense and credit the allowance account. And we're going to talk in the next couple slides about how I got this estimate, but for now, we'll just assume we came up with $5,000. We credit allowance for bad debt for $5,000. And then the second part says post these to these T accounts and see what we get. So accounts receivable here, started with a debit balance of $10,008. And the allowance account, the allowance for bad debt started with a credit balance of $2,000. Oops, stop that. And then we have to update that, and then bad debt expense wouldn't have had anything in it. That would have been closed. That always starts with a zero balance. So we just start with there. And so now we have to update these accounts with what we did down here in the journal entries. So here in transaction A, I debited accounts receivable for $265.08. So I'll put that here. In this B, I credited accounts receivable $220. So I'll put that on the credit side. This is back to just journal entries and T accounts that we did in Chapter 2, so hopefully you still remember all that. In the third one, I debited the allowance account, $6,100, and I credited accounts receivable, $6,100. So I transfer this debit up here to the allowance account. I transfer this credit over here to the accounts receivable account. And then in the fourth one here, transaction D, I debited bad debt expense $5,000, so I'll put this $5,000 up here. And then I credited the allowance for bad debt $5,000, so I put that over here. Okay? And so then we just calculate the balance in each of these accounts. So, in accounts receivable, debit minus credit gives me a balance of $50,500 in accounts receivable. The allowance for bad debt, credit plus credit minus the debit, gives me a $900 balance over here on the credit side. And for bad debt expense, I've got a $5,000 balance on the debit side. And the last one here says, how would this be reported on the balance sheet? And so we would have the asset accounts receivable showing $50,500 minus the allowance, which has a balance of $900, would give me $49,600 as that net realizable value. That's the number that's going to show up on the balance sheet. I mean, you'll see both of those, but that's the ending number that's really relevant on the balance sheet. Okay, so let's talk about estimating this bad debt expense. So how do I estimate what that bad debt expense will be? Oops. Where'd you go? Okay, there we go. Expense will be. I've got three methods. So method number one is percent of sales, and this is the simplest one. This is also referred to as income statement approach. I'm using percent of sales, and sales shows up on the income statement with revenue. So all I do is I take the net credit sales. It's really kind of your total sales, but net of returns and discounts and allowances and all that kind of stuff. So your credit sales times some percentage, and that gives you the amount of bad debt expense. That is the amount of your adjusting entry, okay? Where did this percent come from? It's probably based on past experience or industry standards, not really standards, but what's common in this industry. So if you've been doing this for a while, you'll use it on your own past experience. If you're new to the industry, you would try to figure out what's going on in that industry, what's common for that industry, and that's the percent that you would use. So let's say that your credit sales, your net credit sales, total $60,000, and you expect a 5% that you're going to have to write off. So you would take the 60,000 times 0.05, and you get $3,000. And that is the amount of your journal entry for bad debt expense and credit to allowance for bad debt, $3,000. And that's what you do. That's all you do. You don't have to worry about anything else. That's your entire thing. So let's do one of those problems, and then we'll look at 2 other methods. So during its first year of operation, Signature Lamp Company earned net credit sales of $314,000. Industry experience suggests that bad debts will amount to 4% of net credit sales. And at the end of the year, accounts receivable were $45,000. Using the allowance method and using percent of sales method, I'm going to do the journal entry for the bad debt expense, and then figure out the balance on the accounts receivable. So all I'm going to take is the net sales of 314 times 4% is 0.04, and that gives me 12,560. And that's the amount of my adjusting entry, and that's all I have to do. I'm saying that because in the next 2 methods, we vary a little bit. But in here, that's all I have to do. So for one, I just debit bad debt expense and credit allowance for bad debt. And these are both for 12,560, 12,560. And then on the balance sheet, this would be a current asset, and I would show accounts receivable of 40. Oops, oh, I hate that thing. Sorry, hold on. Okay, it's just like it won't let you just shut it down. You have to just open it up. So our accounts receivable are 45,000. Minus our balance in the allowance account is 12,560 is what I think I'm going to have to write off. And so 32,440 is that net realizable value. And so the percent of sales method is pretty simple. Now, we see that this is, we credit allowance for bad debt when we estimate it, right? When we come up with this estimate. And then when we identify specific accounts, we debit that account. Which means at the end of the year, you could come out, unless you wrote off exactly what you expected, you're going to have some balance hanging around in that account. Either a debit or a credit, depending on whether you over or underestimated. And with the percent of sales method, I don't care about that. So if I was over or under last year, it doesn't matter. I still just write off the 12,560 this year. So I don't factor in the fact that whether I was over or under last year. In the next 2 methods, though, we do have to factor that in. Okay. So percent of receivables. This will be method number 2 of 3, and this is a balance sheet approach, because we're using receivables, which is an asset on the balance sheet. And so what we do is we start out, we take the balance in accounts receivable times some percent. So this is, so far it's similar, right? We're using accounts receivable instead of sales, but we take it times some percent, again, based on our experience or industry experience or something. But what that gives me is not the amount that I want to write off. This gives me my target balance in the allowance account. This is what I want the balance to be. This is not the amount of my write-off. This is what I want the balance to be. So we really have a 2-step process here. One, we determine the target balance in the allowance account. And that's what we said right up here, right? That's just the balance in accounts receivable, times some percentage. Then step 2 is we compare the target balance, what we got in step 1 here, with the actual balance in that account. And the actual balance in that account is the amount that we were over or under last year. And so then your adjustment, or your journal entry, is so you compare the target to the actual. The difference is the amount of your journal entry. Where did you guys go? The difference between the target and the actual equals the bad debt expense, the amount of your journal entry. All right. And so what you're really doing here is adjusting for being over or under in your estimate last year. Does that make sense? Look, you can't answer me because it's a video, but you know what I mean. So, I take, and so let's say, well, here, we'll just do a couple. That'll probably be the easiest way. But in this case, I'm writing off what I expect to write off this year, plus or minus the amount I was off last year. So in this one, the accounts receivable balance for the field company was $25,000. Here's how much they earned on account, $257. They collected $326. They wrote off $5,900. And industry experience suggests that uncollectible accounts will amount to 4% of the receivables. And they're telling us they had an unadjusted balance, a credit balance of 23 for the allowance account. So we want to journalize the adjustment to record the bad debt expense. So the first thing we have to do is figure out what the balance in accounts receivable is, right? So accounts receivable started off with a debit balance of $25,000, okay? It's an asset, so it has to have a debit balance. And then I made sales on account of $457. So I would have debited $457 accounts receivable and credited sales. Then I collected $326. So I would have debited cash and credited accounts receivable for $326. And then I actually wrote off $59. So I would have debited the allowance account and credited accounts receivable for $5,900. Okay? So that gives me a balance in my accounts receivable of $150,100, which is just my debit plus my debit minus my credit minus this credit. So now I take that balance, so a balance in accounts receivable, 150, 100 times 4%, and that gives me 6,004. So that is not my write-off, right? That is my target. So that's step 1, figure out what your target is. Now let's look at the allowance account. It said I started with a credit balance of $2,300. So that's $2,300 over here. And I want the balance to be 6,004. That's where that target goes. So if you started out with a credit balance, that means you did not write off as much as you expected last year. So that means the bad debt expense that you put on last year was higher than it needed to be. You didn't actually write off that much. So what that really tells us is that we get to reduce this year's expense by the amount that we overexpensed it last year, by $2,300. So you could look at that. You could say credit balance means I wrote off too much last year, so I can deduct that from this year's expense. Or you can just look at the T account. Right now there's $2,300 on the credit side. I want it to be 6,004. So the difference, which is 3,704, is the amount of my adjustment. Okay, that's a 0. It's a little hard to read. So what do I need to do to this account to get the balance to 6,004? It has $2,300 in there. So that means I need to credit it another 3,704 to bring it up to 6,004, my target. So the journal entry for this one would be a debit to bad debt expense for 3,704 and a credit to allowance for bad debt, 3,704. So even though I'm expecting write-offs of 6004, there's already 2300 sitting in there left over from last year, so I only actually have to write off 3704 this year. The second one says, assume you had a debit balance of 1900 in the allowance account. So the target remains the same. So now I have a debit balance of 1900 and I still want to end up with 6004. So you could look at it just on the journal entry and say, okay, well then if there's a debit balance of 1900 and I want to end up with a credit, this has to be a credit of 6904 to get me there. And so that's the amount of your adjustment right there. The other way to look at it is, I was short last year. Last year I wrote off 1900 more than I was expecting to. So this year, my bad debt expense has to be the 6004 I'm expecting plus the amount, the 1900 I was short last year. And you add those two together to get the amount of your adjustment. So I'm going to debit bad debt expense for 7904 and credit the allowance account $7904. Okay. Now we have one more method, all right? It's very, very similar to this one, except the way that I get that, instead of taking 1% to all of my accounts receivable, I'm going to break this accounts receivable down into different groups and apply different percent to each one. So if we look back to this one, the process is the same to determine the target balance. I'm just going to break this step right here down into a little bit more detail, and then once I get my target balance, the second part is the same. Okay. So for this one, the aging of receivables, so this will be method number 3. This is also a balance sheet approach. What I'm going to do, instead of applying the same percent to all of my accounts receivable, I am going to break my accounts receivable into, we'll call them age groups, how long that accounts receivable has been sitting there, and age groups, and then I have a different percent for each group. So here's what I mean. Let's say you break your accounts receivable into various age groups. How long that accounts receivable has been sitting there. Let's say you have a 30-day trade credit policy. So the stuff that has been sitting here between 0 and 30 days, it is not late yet, right? Then you've got stuff that's been sitting here somewhere between 31 and 60 days. So it's anywhere between a day and a month late on their payment, okay? Then let's say you have a 61 to 90 day group. So this is stuff that's somewhere running up to 2 months late now. And then let's say you take everything else. These are things that are 3 months late or more, all right? So you can take all of your accounts receivable. Each account you have can be broken into a different group. Let me just pop over to this one. This is kind of what it looks like. They have a similar thing here. And so each person that owes them money for accounts receivable, their balance goes in one of these. Either they are current, like these 3 guys right here. They're a little bit late here. You know, it could just be a couple days. These guys are 2 months. And then these guys here, it's over 90 days. So they're pretty late. And then each group has a different percentage that I apply to it. So generally companies have like so these guys, only 1% of that are going to end up rolling over to something else. These guys, you know, they probably just mailed it a little late. It's no big deal. It's the same. But you get to this 90 days, and then all of a sudden it's 90%. And I think that's pretty common for most companies. You get to a certain point, and once you hit that, there's a very slim chance that you're going to ever collect that. So you have a different percent of uncollectibles for each of these age groups. So if I go back to this one, let's say my total accounts receivable balance of stuff that it's still current was $100,000. And then stuff that's 1 day late, maybe I have $20,000 in receivables there. The stuff that is 60 days, 60 to 90 days. Let's say I have 10,000 there, and I have $5,000 of receivables that are 90 days late or more, or they've been sitting here 90 days or more. And so you total that up, and my total accounts receivable are 135. Now in the last method, I just took this total accounts receivable 135 and applied 1%. But now I'm going to say each of these has a different likelihood, or a different likelihood of not collecting. So estimated uncollectible, let's say I'll give these guys 1%. Most of these guys are going to pay. I'll give these 3%. I'll give these guys 10%. And then once I hit 90 days, I'm probably never going to see that. So 90% of that I will end up not collecting. So this gives me the estimated write-off, we'll say. So $1,000 of this I will probably end up never seeing. 600 of this I will probably end up having to write off. 1,000 of this I will probably end up having to write off. And of that 5,000 that's in this group, I will likely end up having to write off 4,500 of it. So the total is 7,100. Once I do that chart, this is my target balance. So that is step one from the last method. And then I would compare this target balance to what's already in the allowance account and adjust for the difference. So this is what I want the balance in the allowance to be. Then I would have to compare it to what's already in there. And the difference is my adjustment. So that's what we talked again. This is the target balance, not the bad debt expense. Oops. Not the expense. Okay, so let's do one of those. We show that we have 78,000 in accounts receivable and 1,060 in allowance for bad debts. The aging of the receivable, they took all the accounts and they really just break them into two groups, 0 to 60 and over 60. So we take the 73,000 times 2%, that would give us 1,460. And then the 5,000 times 24% is the estimated uncollectible there, and I get 1,200. I add the two together, and the total I'm expecting to write off is 2,660. And again, that is my target balance, not my write-off. So that says I take this guy, right? I want this to end up with 2,660. There's a credit balance in there, which means last year I wrote off less than I was expecting, so some of that is hanging over, right? So I need this to be 1,600 to get to my target balance. So that is actually the amount of my bad debt expense. 1,600. So the 2,600 minus the 1,060 that's already there. So my debit to bad debt expense is 1,600, and that will bring me up to this one. And I credit allowance for bad debt 1,600, and it says prepare a T account. Well, that's what we did in order to get that number, because I think that's the easiest way to do it. And my ending balance is 26. The ending balance is the 2,660, which is what I came up with here as my target. So just a couple slides. These are things out of the book to show you a comparison. These are the journal entries that you need. So the direct write-off, when I recognize it, I just debit bad debt expense and credit the accounts receivable. If I recover it, I reinstate it here and then collect the cash. And there's no adjusting entry for this one. For the allowance method, at the adjusting entry, I do this. This is a debit to bad debt expense and a credit to allowance, and that's when I estimate the adjusting entry for what it's going to be. And then when I identify specific, when I recognize a write-off, this is my journal entry here. And then if I reinstate it again, the reinstating is just the undoing of the bad debt. So I credit accounts receivable and I credit the allowance, and then I record the payment. And just a comparison of these three methods. If it's the income statement, the percent of sales, all I do is bad debt expense, and that is the amount of the bad debt expense is just the credit sales times that percent. For the balance sheet approaches, I have to take the accounts receivable balance times the percent to get the target balance, and then compare that to what's in there. And if you're doing the age of receivables, I'll just say step 0 before you get to step 1. So step 0 is to break the accounts receivable into those age groups, and then apply the percent to each one, and then that'll give you your target balance, and then you pick up with step 2. Okay, so I think I'll stop it here for this one, and then come back and do another video for the notes receivable.